Ever wondered why the Dow Jones Industrial Average closed lower today? Well, let's delve into it, shall we? The Dow Jones took a dip, primarily due to a slide in Walmart and an energy slump. Now, what does this all mean? First off, we need to comprehend that the stock market is a mirror of the economy. It reflects what investors think about the current health and future prospects of the economy. So, when we observe weaker than expected economic data, it raises concerns and directly influences the market. Now let's talk about Walmart, the largest U.S. retailer. Despite raising its annual guidance, it fell short of estimates, leading to an over 8% drop in its shares. The company cited inflationary pressures causing consumers to delay larger purchases. This is significant. It's a sign that people are feeling the pinch, and it's having an impact on the spending patterns that drive our economy. And it wasn't just Walmart. Cisco Systems, a major player in the tech industry, saw a nearly 10% drop in its stock after reducing its full-year revenue and profit forecasts. This indicates a slowdown in demand for its networking equipment. Similarly, Palo Alto Networks fell 5% due to lower-than-expected billing guidance. But it's not all doom and gloom. The S&P 500 and Nasdaq Composite both managed to inch up by 0.1%. And Macy's, another big retailer, rose 4% after exceeding third-quarter expectations and raising its full-year guidance. So, we see that the market isn't just influenced by the negative, but also by the successes of other companies. Weaker economic data, including higher weekly jobless claims and a Philadelphia Fed index still in contraction, raised concerns about a slowing economy. Despite this, a U.S. government shutdown was averted as the Senate passed a stopgap spending bill. So that's why the Dow took a hit today, but what about the oil market? Stay tuned as we navigate the ebb and flow of oil prices in our next segment. Did you know that the performance of major retailers can heavily influence the stock market? Let's take a look at a few examples. Macy's, a well-known department store chain, exceeded third-quarter expectations and raised its full-year guidance, causing a 4% rise in its shares. This performance not only bolstered investor confidence in Macy's, but also contributed to the overall positive sentiment in the retail sector. In contrast, we have Walmart, the largest U.S. retailer. While it raised its annual guidance, it fell short of estimates. This led to an over 8% drop in its shares. Walmart cited inflationary pressures as a reason for consumers delaying larger purchases. The decline in Walmart's stock price not only impacted the company's market capitalization, but also influenced the overall market mood. But it's not just retailers that can sway the market. Tech companies like Cisco Systems and Palo Alto Networks also play a significant role. Cisco Systems saw a nearly 10% drop in its stock after reducing its full-year revenue and profit forecasts. This indicates a slowdown in demand for its networking equipment. Similarly, Palo Alto Networks fell 5% due to lower-than-expected billing guidance. The performance of these tech giants can often serve as a barometer for the broader tech sector and the market at large. The stock market is a complex ecosystem where the performance of individual companies can have ripple effects throughout the entire market. Whether it's a retailer exceeding expectations or a tech giant falling short, these performances can influence investor sentiment, sector trends, and market indices. As we delve deeper into the intricacies of the stock market, it's clear that every player, every sector, and every piece of economic data plays a part in the grand tapestry of this financial marketplace. The performance of these companies can have ripple effects throughout the market. Now, let's move on to the energy sector. You might be wondering, how does the energy sector performance affect the economy? Well, let's take a step back and consider the bigger picture. A well-performing energy sector is like a well-oiled machine, fueling economic growth and stability. However, when things go awry, the ripple effects can be significant. Recently, we've seen higher weekly jobless claims and a contraction in the Philadelphia Fed index. These are key economic indicators, and their current state has raised concerns about a slowing economy. Jobless claims are a measure of the number of people filing for unemployment benefits. So when these numbers rise, it signals that fewer people are working and therefore less money is being pumped into the economy. Similarly, The Philadelphia Fed Index is a measure of manufacturing health in the East Coast region. When this index contracts, it suggests that manufacturing activities are slowing down, which could lead to job losses and reduced economic output. Now, amidst these concerns, another potential crisis was averted. The Senate passed a stopgap spending bill, preventing a U.S. government shutdown. This move ensured that government services continued uninterrupted, maintaining stability in the midst of economic uncertainty. But let's shift gears and talk about individual companies within the energy sector. Take Plug Power, for instance. The company saw a near 4% decline after Citi downgraded its rating. The reason? Concerns about the company's execution and liquidity risks. Citi even estimated that Plug Power needs around $500 million in cash over the next 6 months. This situation is a stark reminder that individual company performance can also have substantial effects on the overall energy sector and consequently the economy. As we can see, the energy sector plays a crucial role in the economy. Let's now delve into oil prices. What causes oil prices to slump to a 4-month low is a question that's been on many minds recently. The answer lies in the interplay between global oil demand and economic data from two of the world's major economies, the United States and Asia. Broadly speaking, when economic data points to a robust economy, the demand for oil typically increases. This is due to the fact that a strong economy means more industrial activity, more transportation, and generally more energy consumption. Conversely, when economic indicators suggest a slowdown, the demand for oil can decrease, leading to a slump in prices. This is precisely what we've been witnessing. Recent data suggests a slowdown in the U.S. economy. The number of Americans filing for unemployment has reached a 3-month high. This, coupled with a decline in U.S. retail sales for the first time in 7 months, has raised concerns about the economic health of the nation. Moving on to Asia, the story is quite similar. The economic data coming from this region hasn't been particularly encouraging either, leading to concerns about global oil demand. Another factor contributing to the fall in oil prices is a situation known as contango. This is when the front-month contracts for oil are trading at a lower price than contracts for delivery in the future. This scenario often indicates an oversupplied market and can exert downward pressure on oil prices. But let's not forget, oil is a global commodity. Its price is not only influenced by the economic health of individual countries, but also by international events and geopolitical factors. Taking all of this into account, it's clear that the slump in oil prices to a 4-month low is a reflection of broader economic concerns. Oil prices act like a mirror, reflecting the economic state of our world. Oil prices can be a reflection of the economic state. Now let's discuss international influences on oil prices. Are you aware of how international events can affect oil prices? This question becomes particularly relevant when we delve deeper into the geopolitical intricacies and the global economic ecosystem that can have a profound influence on oil prices. Take, for instance, the recent escalation of the Israel-Hamas conflict. This geopolitical tension, coupled with the U.S. officials' renewed intention to enforce oil sanctions against Iran, a longtime supporter of Hamas, caused ripples in the oil market. Sanctions on Iran, a major oil producer, could potentially reduce the global oil supply, causing prices to surge. On the other hand, the global oil market is not governed solely by geopolitical events. Economic factors and forecasts also play a significant role. The Organization of Petroleum Exporting Countries, or OPEC, and the International Energy Agency had anticipated a supply tightness in the 4th quarter. This prediction was based on the expectation of increased global demand during the winter months. However, the reality turned out to be different, as U.S. data revealed plentiful inventories, which exerted a downward pressure on oil prices. Let's also consider the role of the world's second-largest economy, China. An expected slowdown in Chinese oil refinery throughput in October sparked concerns. Despite positive economic indicators, this slowdown could imply a reduced demand for oil, and as the law of supply and demand dictates, when demand falls, prices are likely to follow. In sum, oil prices are influenced by a complex interplay of geopolitical events, economic forecasts, and actual supply and demand dynamics. These factors can change rapidly, causing oil prices to fluctuate. And since oil is a key input for many industries, these price changes can have far-reaching effects on the stock market and the wider economy. International events can have a significant impact on oil prices, which in turn can affect the stock market. It's crucial to keep an eye on these factors when considering investments.